Welcome to WorldWire. Please subscribe and hit the bell icon for more breaking updates. A major move has been made, one that could reshape the balance of power in global trade. On the global economic chessboard, every decision is strategic, and this one is no exception. The world's supply chains are interconnected, and a single action can send ripples across continents. The United States has blocked a $200 million ethane shipment to China, a calculated geopolitical strategy that goes far beyond a simple trade dispute. Ethane, a crucial component for plastics and chemicals, is at the heart of this standoff. Under a new rule from the U.S. Commerce Department, exporters now need a special license to send high-purity ethane to China. In this case, the license was denied, effectively halting the shipment in its tracks and setting a precedent for future deals. The decision sent shockwaves through the energy and shipping industries, leaving tankers stranded offshore and companies scrambling to adapt. Billions of dollars in contracts and investments now hang in the balance. For years, the U.S. has been a primary supplier of ethane to China, fueling the rapid growth of its petrochemical industry. American ethane has powered Chinese factories, created jobs, and deepened economic ties between the two nations. Now, the blockade disrupts a lucrative supply chain, forcing companies to seek alternative sources and routes. It signals a potential rewrite of global trade rules as both countries reassess their dependencies and vulnerabilities. The U.S. frames this decision as necessary for national security and fair trade, arguing that critical resources should not be used to strengthen a strategic rival. Officials say it's about protecting American innovation and industry. The timing suggests a coordinated effort to pressure Beijing, coming alongside a wave of other restrictive trade measures. It's a clear message: the U.S. is willing to use its economic leverage to shape the future of global commerce. For American producers, this is a stark reminder of how quickly policy can alter market dynamics. Overnight, what was once a booming export market can become a battleground for international influence. This event sets the stage for a new chapter in the ongoing economic saga between Washington and Beijing, with the world watching to see who will make the next move in this high-stakes game. What is ethane, and why does it matter? While it may not be a household name, ethane is a silent powerhouse driving much of the modern world. It's a colorless, odorless gas, often overlooked, yet it plays a pivotal role in the global economy and in our daily lives. Ethane, classified as a natural gas liquid, is extracted alongside methane from natural gas fields. Its unique chemical properties make it a crucial feedstock for the petrochemical industry, where it is transformed into essential building blocks for countless products. The American shale gas revolution, fueled by advances in hydraulic fracturing and horizontal drilling, unlocked vast reserves of ethane. This technological leap made the United States not only energy independent, but also a dominant force in global ethane production. In sprawling chemical plants, ethane undergoes a process called steam cracking, where it is converted into ethylene. Ethylene is the foundation for plastics like polyethylene, which are used in everything from packaging and toys to medical devices and automotive parts. As China's economy expanded rapidly, its appetite for plastics and other petrochemical products soared. To meet this demand, China became one of the world's largest importers of ethane, relying heavily on shipments from the United States. In response, Chinese companies invested billions of dollars in state-of-the-art chemical plants specifically designed to process imported U.S. ethane. These facilities became the backbone of China's booming manufacturing and export sectors. This deep reliance on a single supply chain made the entire system both highly efficient and extremely vulnerable. Any disruption, whether from politics, logistics, or natural disasters, could send shockwaves through global markets. When the flow of ethane is interrupted, it's not just chemical plants that feel the impact. The effects ripple outward, leading to factory slowdowns, shortages of everyday goods, and rising prices for consumers around the world. The U.S. decision to restrict ethane exports is more than a trade policy. It's a strategic move that targets a vital sector of China's industrial machine, with the potential to reshape global supply chains. If manufacturers are forced to switch to alternative, more expensive feedstocks, their production costs rise significantly. This can erode profit margins and force companies to pass those costs on to consumers. The result: higher prices for goods ranging from electronics to clothing, and increased volatility in global markets as companies and countries scramble to adapt. The blockade poses a direct challenge to China's industrial growth and its dominance as the world's factory, threatening to slow exports and disrupt the flow of goods worldwide. In the end, the importance of this single molecule, ethane, cannot be overstated. It is the unseen engine powering industries, economies, and the very fabric of modern life. Blocking ethane shipments is the latest move in the US-China trade war. The new rule requires a license for high-purity ethane exports to China. This policy gives the US control over a vital resource stream. It's part of a broader strategy to curb perceived unfair trade practices. The rule's implementation created chaos, with exporters facing logistical challenges. The US action overrides previous trade arrangements, escalating tensions. It signals that no sector is immune from geopolitical competition. The battle for economic influence has opened a new front. As the US halted ethane exports, Canada and the UAE seized the opportunity. Both countries are significant natural gas producers and quickly filled the void. Canada, with its integrated energy infrastructure, was well positioned to act. Canadian producers secured new supply agreements with Chinese buyers. The UAE, a global energy powerhouse, also moved to secure contracts. This realignment shows no country holds a permanent monopoly on commodities. The US blockade may have accelerated China's strategy to diversify suppliers. China is now more resilient, reducing dependence on any single nation. The global ethane market has shifted, with new players emerging. The US export policy's immediate victims are American energy companies, who have long relied on international markets to drive growth and sustain jobs across the country. These firms, many of which are major employers in their regions, suddenly found themselves cut off from one of their most lucrative customers. Over the past decade, these companies invested billions in infrastructure, building pipelines, storage facilities, and export terminals, specifically to serve the booming Chinese market for ethane and related products. These investments were made with the expectation of stable, long-term trade relations. The sudden blockade left them with stranded assets, idle equipment, and mounting financial losses. Projects that once promised steady returns now face uncertainty, and some companies may be forced to lay off workers or scale back operations. Now, these businesses face the daunting challenge of finding new buyers for their product in an already competitive global market. Negotiating new contracts takes time, and not all markets can absorb the same volume as China. On the other side, Chinese importers, who had become reliant on a steady supply of US ethane, must quickly pivot to secure alternative sources to keep their factories running and meet domestic demand. Sourcing ethane from countries like Canada or the UAE involves higher transportation and procurement costs, which can erode profit margins for Chinese manufacturers and disrupt established supply chains. This trade disruption is not isolated. It will ripple through the global economy, affecting shipping companies, logistics providers, and even industries unrelated to energy as costs and uncertainties mount. Higher production costs in China could eventually lead to increased consumer prices, impacting everything from electronics to everyday goods, and potentially fueling inflationary pressures worldwide. Beyond immediate financial losses, this episode raises serious questions about the US's reliability as a global supplier. Trading partners may hesitate to enter long-term agreements, fearing sudden policy shifts. Trust, once lost, is incredibly difficult to regain. The damage to America's commercial reputation could have lasting consequences, making it harder for US businesses to compete on the world stage for years to come. The response from affected industries was swift and concerned. American energy producers argued the new controls harm US businesses. They pointed to falling stock prices and port chaos as evidence. The Chinese government condemned the US action as economic coercion. China worked to secure alternative supplies, showing pragmatism. The shipping industry faced mounting costs and uncertainty. The blockade highlighted the vulnerability of global supply chains. Multinational corporations now reevaluate sourcing strategies. The methods used create significant economic collateral damage. The US ethane export block marks a pivotal moment in global energy markets. Geopolitics now plays a dominant role, altering the competitive landscape. Canada and the UAE have emerged as credible alternatives. China's strategy of supply chain diversification will accelerate. The US faces uncertain long-term consequences, risking economic costs. Trust and predictability are valuable assets in a competitive market. The ethane blockade may fracture the globalized world into economic blocks. Strategic competition now defines access to resources. This new world order creates challenges and opportunities for agile players. The race to secure resources and markets has irrevocably changed.